Good morning, everyone. My name is Roger Scott, and I'm the senior strategist of Wealth Press. Today is, what is today? Today is Tuesday. Yes, it is. It's the 23rd of March. It's the third week. It's the second day of the third week of March of 2021. There, I said it. I'm trying to do this every morning so I don't lose track of days. I've actually been losing track of days. I have like a big black hole in the first March, April, May of 2020. I don't remember what happened. Anyway, it's 8:15. The market's going to open up in about an hour and 15 minutes or so. Want to go through global economy. Want to talk to you about where the dangers, where the threats, and where the opportunities are. But let's start with economy. We got new home sales report. It's coming out in about 2 hours and 15 minutes. I don't think anything bad is going to happen. I think the report is going to be positive. The report consensus is a little lower. We went a little too hot. Economists believe last month, 923,000. We're now going to look at 875,000. But I got to say, the numbers have been pretty good. And even if we go a little bit lower to 825, 850, 900, it's all good. The truth is, new home sales have been rocking and rolling this year. Now, if you look at the indices, we went up a lot yesterday in the NASDAQ. Right now, we're a little kind of softish, if you will. If you want to call 4 points up, I really wouldn't call it up. Now, if you look at the put-to-call ratio, this is a measure of momentum and option sentiment. And it measures the total puts-to-call ratio. If the number goes below 0.70, it means the market's getting overly bullish. If the number gets above 0.975, it means the market's getting a little too bearish. As you can see here, the number is making its way towards 0.70, and the highs, every time we've been moving higher, away, in other words, towards the bearish side, it's been moving lower, which means the market is getting overly overbought. If the highs are getting lower, that means the market can't pull back far enough to stretch out, which is why we're having a fragmented market, because we're in an overbought economy. Now, if you look at the number of stocks trading above the 200-day moving average in the NASDAQ, we are now at 80%, which means 80 out of 100 stocks in the NASDAQ 100 are trading above the 200-day moving average. And if you look at that historically, this is going back 20 years or 13, 14 years or so, give or take about 15 years, you will see we don't go above this line very often. Here's the 80th percentile. And every time we have, as you could see right here, right here, right here, right here, let me put a little drawing tool here. We do a little vertical line here. Oh, not vertical. I want to do a horizontal line. What am I doing here? I'm losing my mind. Horizontal line, not a vertical line. There we go. There's the horizontal line. Let's remove this line, vertical line. So as you could see here on this line here, that we don't really go above this line very often. And if we do, we tend to cool off. Now, we went to the highest level since 2010. So I don't expect us to stay around here very, very much. And if you look technically, we're already trading, as I mentioned, below the 50-day moving average, and this market doesn't look very strong. So if you look at the put-to-call ratio with the fact that we're already stretched out at 0.72, we're going to go down here, which means the market's going to be overly bullish and stretched out, which is also one of the reasons, and I'm going a little deep here, but it's good to go deep because I want to show you all the things that I'm looking at. If you look at the cumulative strength index on the 10 major sectors, and if I organize them, you will see that technology and consumer discretionary are not next to each other. Healthcare is between them. That they're usually next to each other, and that's telling us markets are fragmented, which is confirmed by the put-to-call ratio with the number of stocks trading above the 200-day moving average for quite some time here. Notice we don't trade all that long here, maybe a couple of months, and then we cool off. And when we do, we go down. And if this thing cools off and momentum levels go down, we are going to end up at the 200-day moving average, which is what I believe we need to do to flush ourselves out of this bearish sentiment in NASDAQ and continue moving higher. But I don't think that's going to happen until earnings confirm that we're going to see better end-of-year earnings per share numbers on the NASDAQ in comparison to the yield on the bond market. And as you could see here, the bond market right now, it was up quite a bit yesterday. It is right now Look at this. It's coming back up, but I'm not very confident that this trend will continue moving higher. I think it'll revert down, and if it does, that means Nasdaq will go down too. There's a huge correlation right now between the bond market and Nasdaq, because if bonds go lower, that means interest rates go higher, and if interest rates go higher, there's less reason to look at large cap tech stocks because their yield comes with volatility, whereas the long bond comes with 100% guarantee from the Fed. So that's kind of a little explanation. I've been kind of going over this day by day and throughout the days. Now, global economy, let's quickly go through that, and then I'll give you guys a couple of really good stocks that I'm looking at right now, not tech-related stocks. Federal Reserve promised to support the economy. Washington, Europe announced sanctions against China, accused of human rights abuses. Let's see how far that goes. Big tech companies led stock broadly higher yesterday, Amazon, Apple, Microsoft, but as I showed you, this put to call ratio. Folks, till this gets resolved, till this moves back down here, we're not going anywhere. Again, I'm just being realistic with you. Shares were boosted by a rise in bond prices. Remember, bonds and tech are locked in right now, which narrowing their yield, or the difference between their market price and the payout at maturity. A rise in bonds has been luring investors out of high-priced tech stocks. That's what I've been saying. If bond prices go down, that means interest rates go up. If interest rates go up, that means you're getting more with risk-free, because interest rates from the government, bond from the government are about as risk-free as you can get, whereas tech stocks have a lot of volatility. So keep that in mind. Investors are wavering between optimism that COVID vaccines that might allow businesses and travel to return to normal, and fears of high inflation after struggling economies were flooded with credit and government spending. That's really where we're at right now. And I think tech is just a little bit overbought for what we're seeing right now. They have been reassured by Powell's comments earlier that the Fed's key interest rates will be kept near zero through 2023. Yeah, tell that to the long bond. Tell that to the long bond, Powell, okay? Through 2023. The yield on the 10-year Treasury note narrowed to 1.65 after trading as high as 174 last week. That's when it went right here. This is 1.73. This is 1.63. This is around 1.5. And I think we're going to go lower to about 2.5 before the year is done. So again, and that's going to negatively impact the lower bonds go, the lower tech stocks will go, because that's going to negatively impact the yield that we're going to get from the Nasdaq 100 at the end of the year. So if earnings for the large cap tech can show us next quarter that we can outperform by a substantial amount, that means the interest yield that you'll get from the earnings on the tech can substantially keep outperforming the bond market, and then means tech will start moving higher again. But right now, I wouldn't hold my breath, because the Nasdaq 100, as you could see right here, still remains below the 50-day moving average. And I think we need a good, healthy flush out taking us right down to here before we go higher. That's what the sentiment level says. Because if you look at the number of stocks trading above the 200-day moving average, it is, on a monthly basis, we are grossly, grossly overbought. Now, I want to give you guys 3 stocks that I'm really liking right now. First is Discover Financial. We made a swing high, multi-year swing high here. It's like the highest high in 3 years. Let's see, 5 years, 10 years. We are at the highest high here as far as I could tell. We made a 90-day high and an all-time swing high. We bounced to the 50-day moving average and made a 10-day low, flushed out the weak hands, and I think we're going to go higher, and I think we're going to go test a high. So I would put a buy stop right at the 95.50 level, put a liquidation stop at 92.50, and ride the sucker all the way to the top. That's DFS. Next one, Regency Centers, shopping centers. And guess where they're located? They're located in Jacksonville. Guess where I'm doing this video from? 1-year return, 58%. Shopping centers, developing properties, real estate, it's all coming back. And Regency Centers is one of the biggest ones. Made a multi-swing high. Let's see, 2 year? Nope, not a 2-year. But we're getting out of those levels where we were pre-COVID. So we were bouncing back, made a 90-day high, made a 10-day low, and closed near the high. Still far away from the 50-day line. I would put a buy stop at 56.20, liquidate it around 54.50, and ride it all the way to the top. And I've got another one for you, ADM. Archer Daniels. Let's look at this. Again, swing high, multi-month swing high right here, 90-day high, and let's look at a 5-year. 5-year high, highest high of all time. I like buying stocks that are breaking down from all-time highs. Multi-month high, 90-day high, 10-day low, swinging back up. Put a buy stop around 56.50, liquidated around the moving average 54.80, 54.90, ride it all the way to the top. That's ADM, that's DFS, and that's REG. All right, Regency Centers, Archer Daniels, and Discover Financial Services. They're all either in REITs or in the financial sector. Now, folks, before I let you go, I've got something big for you, something important. Did you know that some of the world's most popular stocks are within your wheelhouse? And it doesn't matter if they go up, down, or sideways. Wall Street legend Chuck Hughes, he has a brand new strategy that's giving everyday traders the chance to profit on thousands of stocks. Even stocks like Amazon or PayPal. Even if you have a small account, completely hedged, no matter if the market's going up, down, or sideways. You can even start with as little as $1,000 and build it up. And the opportunities come not once a year, not once a month, every single week. Every single week. Folks, in his latest discovery, he's already used it to signal winner after winner, even when the markets are turbulent. And you know how often he's right in real-time trading? 96.3% of the time. Can you imagine 96.3% of the time over 7 years? And you can discover exactly how to use it without buying a single share of stock. Small account allows you to trade large stocks like Amazon without spending thousands of dollars for 5 shares. You know, Amazon's like $3,000 a share. You can trade stocks like Amazon. You don't have to be right about market direction. You could do it in a small account. I love it. All you've got to do is click on the link below to see Chuck's mind-blowing profit generator in action right now. You've got to check it out. And you don't even have to own a single share of stock. Can you imagine making money regardless of the direction of the market? 96.3% of the time, 7-year real track record, big account, small account, it doesn't matter. Some of these trades you could take with like a $775 account. He'll show you everything. Follow the link below and find out about Chuck's mind-blowing profit generator in action right now. And make sure to like this video, subscribe to this channel if you're watching on YouTube. Be the first to be notified when we post our next video. And have an amazing day. You've got to check out Chuck. He is something else. There's a reason why they call him the heavyweight trading champion. Bye, guys. Have a great day.